This is how the Trump-Zelensky meeting should have gone.
That was yours. We thought that baggie belonged to Hunter. You know, I think the Secret Service probably still has it somewhere.
I have been stealing the money.
I'm sorry, what's that now?
I must to speak honestly. I steal many of USA dollars to Ukraine. Millions. Some dollars for some oligarchs also, some for American bureaucrats also.
Well, we know that, but why are you telling me this?
Because, Mr. Trump, if you end war, we cannot steal any more money. We must continue war.
No, the war must end. Your people are dying, Zelensky. They're dying.
But I want to steal more money. What do you want? Fellatio, I can do it.
No, I don't want fellatio. No.
Are you sure? I did for Biden.
Okay, that is what we call oversharing. Look, there's nothing you have that I want. You're not going to convince me to keep this war going. You don't have the cards.
I not play cards.
No, I know you're not literally playing cards. It's a metaphor. It's like I'm playing 4D chess and you're playing checkers.
No, I not play checkers. There is no checkerboard, you see.
Okay, let's try this. I am in the driver's seat, okay? Do you understand that expression?
No, but we are not in car.
No, you're right. We're not in a car. That's true.
Listen, Mr. Trump, I am actor/comedian. I crave attention. Since start of war, I get worshipped by presidents. I'm worshipped by Hollywood. If war ends, no more attention, no more worship. With all due respect, Mr. Trump, this war must last forever.
I tell you what, if you agree to end this war, we will do a remake of Friends, and you can play Ukrainian Chandler Bing. How does that sound?
Oh, I love the Friends. This is favorite show of me. I am such a Monica.
Fantastic. Okay, so let's sign the thing, and then I'll go show you the room where Bill Clinton and Monica Lewinsky did it.
Oh yes, this is funny because I just say I'm such a Monica. Maybe we will go in a room and you can be Bill Clinton and I will be Monica. Yes?
You know what? Forget the room. Let's just sign the document. Does anyone have a...
Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks plummeted on Monday afternoon as selling accelerated in the last couple hours of trade after President Trump indicated there was no room left for tariff negotiations with Canada and Mexico, with levies against both countries set to go into effect tomorrow. It was a very red day across the board. The only green we saw today was defensive sectors. Look at insurance here in financials, right? They were kind of green. They're the defensive part of financials. Healthcare was green and certain healthcare stocks. Real estate, which to a degree is defensive, especially when we have yields falling like they did today. Utilities, the quintessential defensive sector, was very green. Same with telecom services. Many people don't know that this sector right here is a defensive sector. And then we had consumer defensives. You could see excluding Walmart and Costco, which is the growth components, all the other parts of staples was actually very green today. Everything else was very, very red. I mean, look at Google, Meta down 2%, Amazon, Tesla down 4% in consumer discretionary. Apple was down 2%. Most of semiconductors, software, Nvidia was down 9%. Absolutely brutal. We're going to talk about why Nvidia was such a dumpster fire today. And then Microsoft down 2.35%, leading the entire infrastructure space lower. And it was just a brutal day. There was a couple of green though. Like I said, the defensive sectors, real estate, staples, healthcare, utilities, like the quintessential defensive sectors, this type of stuff you see when things are going wrong. That's exactly the sectors we saw today. And we saw a rotation out of technology, energy, materials, discretionary, highly cyclical, growth-orientated sectors. We saw rotation out of those into defensives, and even gold up 1.31%. So definitely defensive, safe haven buying going on under the hood. But growth and smalls getting absolutely hammered today. And it was sort of this high beta growth trade that really took it on the chin today. There was no winning factors today. Even mid-cap core, mid-cap value, large-cap value took it on the chin. But they outperformed the growth and high beta components of the market, relatively speaking. Now, why were we so disastrously red today? it had to do with economic growth. Guys, we got the manufacturing data today, and PMIs were down marginally, but new orders was down a lot, prices paid jumping higher, the final manufacturing, while still above 50, and then the employment manufacturing number came in at 47.6. The forecast was actually for expansion. We saw a little bit of contraction right there, and that didn't help the growth picture today. We also got the Fed's GDP now. It was a negative 1.5%, fell to negative 2.8%. There was also some very, very big news from Donald Trump. He came out and said tariffs will go into effect tomorrow. He said there was no room left for a deal that could avoid tariffs on Mexico and Canada. So that's going to be 20% tariffs on both these countries. There's also going to be a 20% tariff on China. It's currently 10%, but another 10% will be added on tomorrow. And then Trump also came out and said that he's going to put tariffs on farming products starting in April. So, we are starting to see an acceleration here of tariffs on farming goods, and then reciprocal tariffs, I believe, are also going into effect on April. So there's going to be a lot of tariffs, and the market just didn't like that at all. Now, for the most part, the global market was actually very, very green. Europe was green. Same here with Asia, Australia, Southeast Asia. However, Canada was very, very red. Mexico was red too. America as a whole, we do know it was red as well. So this American segment, the countries that are really going to feel the tariffs, really taking it on the chin, but China was green. And I think that's a bit of a bet. And the reason why China was green today was because there was more stimulus announcement from the government, and that's always going to prop the market up. Nonetheless, the real pain in today's market was here in the US, in Canada, in Mexico. And we do know that the US makes up 70% of the global equity market. So I think the majority of investors who are indexed to something like the All Country World Index, the ACWI, really feeling the burn today after the US. It was a bit of a dumpster fire. Now, part of the reason why we saw a very red day in the US had to do with Nvidia. Now, their shares tumbled nearly 8% on Monday after a report emerged that Chinese buyers were circumnavigating US export controls to get a hold of its latest chips. Chinese traders were selling systems housing Nvidia's Blackwell chips by sourcing the product through third parties in nearby regions in places like Singapore and Malaysia. Such moves would violate US export rules, with the report noting some sellers were posing 6-week delivery times to buyers. Absolutely insane. So I don't know how this is going to affect what the Trump administration does with these export controls, but it's very clear that there's some underhanded methods to get these Nvidia systems, and in fact, they're actually getting the newest Blackwell systems as well. Nvidia, as a result, was down 8% at one point, nearly 9%. We saw a bit of a rebound here towards the end of the day, but yeah, just making lower lows, lower highs into the close. And all semiconductors were affected by this. Broadcom was down 5% as a result, and the tech space as a whole fell on the back of everything we really saw today with Trump growth, as well as the Nvidia report. Now, there was some green European defense stocks. BAE Systems is up 14%. They did very, very well today. Now, a stock I've been buying a lot of is Evolution Gaming, and it was up 2.5% on some legal wins that's about to occur sometime this week. However, guys, it was a terrible day in the market. Market breadth was just atrocious. 1,400 advances, 4,800 decliners. We saw outflows in the NASDAQ 100 and the New York Stock Exchange. The S&P 500 down 1.7% today, and market momentum looking a little sick as well. The 5-day, 20-day, shorter term, medium term, longer term moving averages all below the 50% mark. Market momentum not that great. Trends are a complete mess, but let's hop on the charts. Now, risk assets as a whole were down in a very big way. The S&P 500 down 1.7%, the NASDAQ 100 down 2%. The IWM was the worst performing asset, down 2.73%. We are seeing a little bit of positive price action here in the after hours, but after a day like this, net, it was a pretty ugly day, all things considered. Now, we did actually see yields move down on the back of weaker than expected economic data, and the dollar actually fell on the back of the tariff news. So it really goes to show that, and what the market is definitely pricing in right now is weaker economic growth that really coincides with the weaker dollar and yields falling respectively. Now, guys, you could definitely tell it was risk off because the White House came out and announced a strategic cryptocurrency reserve. Bitcoin pre-market was up 8%. You can see by this white candle right here, and then actually down 9% here on the day. So it just was a risk risk-off day, and you could see we piled into safe haven stuff like gold, stuff like silver, metals, as well as bonds. TLT was up 0.15%, and then the AGG was kind of flat here today. But actually, if you look at it from the lows, it was up in a very, very big way. So bonds were bid, gold was bid, risk assets we saw outflows from, and the gamma zone, the S&P 500 moved in a very big way. Pretty sure that the positive gamma line was pretty much here to start the week. We've now moved down in a very big way. The S&P 500 in negative gamma. The put support moved lower. The core resistance moved lower. This is not something you actually want to see. Now we are at a critical line of support. We use this as support right here, right here, right here. And also this line of support was where we made the Trump gap up upon the election. So if this line breaks, we're going to make a very, very quick move to the 5,600 area. Now, measuring from peak to trough to where we closed, we're actually only down 4.81% in the S&P 500. So it's not like a crazy move, but we are seeing a drawdown nonetheless. Now, on the weekend video, I said the S&P 500 needs to go ahead and take out this level right here. This is where the gamma flip was. I said we need to go ahead and take out some of these highs. If we couldn't, we probably will move lower into the week. We couldn't take out those highs. We couldn't break above that level, and we've moved lower below the gamma flip into positive gamma, that into negative gamma. That means our target right now is this 5698. Let's just call it the 5700 area. And it's sort of the lows that we made here right before the Trump gap up. So this is a very critical level, but this is also a very, very critical level. So the bulls need to put in work right here. Otherwise, we're probably going to the 5700 area. And below here, it's a stair step to the 5500 area. And I believe that this would be a 10% drawdown from peak to trough to this level, or 11%, close to 10%. So I think if we don't hold this level right here, guys, if we break this and materially move lower on volume, I think we're probably going to see 5,500 in the interim, but 5,700 would be our first initial target. So things not looking good. Do expect some form of like a relief rally come maybe tomorrow, but for this relief rally to have any tangible value, they're going to have to go ahead and break above this level right here, because this is where the selling started right here at the 59.85 level. We don't go ahead and break this level. I think we do see a lower high put in for the S&P 500, and then us to go ahead and make lower lows to the 5,700 area. Things not looking good for growth for the economy. There's a lot of things not lining up. Economic surprises are looking very, very weak, and as a result, equities are going to sell off. So guys, look, if you want to hedge your portfolios right now, I would look at something like TLT, maybe AGG, get some bonds, get some defensive assets in there, as well as gold. So really hoping gold would get to this level right here, but it doesn't look like we are. I think gold is probably going to go ahead and break these highs just because the market kind of worried about tariffs, and gold is a great inflation hedge, tariff hedge, geopolitical hedge as a result. Now let's actually go ahead and look at the NASDAQ 100. Let's actually measure this peak to trough to see where we actually stand. So this was the all-time high in the NASDAQ 100 to where we closed. Roughly, we're down about 8%. We're not quite at a correction. A correction is anything greater than a 10% drawdown. We had about 8.1%. However, I do believe that the put support would probably make it a 10% correction. Yeah, right about 10%. So this week, if we go ahead and touch the 19,830 level, which would be the put support, that would be a 10% correction for the NASDAQ. I do expect some form of a relief rally. We are seeing this here in the after hours, right? Do expect some form of a relief rally, but until we actually go ahead and break above this high, as well as some of these highs we made right here, unless it actually happens, do expect us to put in a lower high and for us to continue the move lower, targeting anything below the 20,000 mark. Again, this was the Trump gap up right here, and we are like the S&P 500, and like the S&P 500, we are at a very, very critical level. Also, when you zoom out, right, this is the same level where we used it as resistance right here. Now, resistance does often turn into support. It did here. However, when we break these key zones where resistance turns into support, and we break those support levels, it likely means we do go lower. So our target would be 19,800. But ultimately, if this level doesn't hold right here, we would then target the lower end of 18,400. And then if we go ahead, measure everything peak to trough, right? we'd be looking at a correction close to 17% in the NASDAQ 100. So guys, I am definitely a little bit more bearish. Equities need to go ahead and capture these very, very key levels in the NASDAQ 100, in the S&P 500, and it doesn't look like they are. Momentum is clearly on the side of the bears, and I would probably get defensive. If you've made a lot of gains in a lot of stocks right now, something like Meta, build some cash. If you like stocks that are cheap, stuff like Evolution, right, maybe you can start deploying capital like I have, okay? But longer term investors, what you want to do in times like these is just sit through the volatility, maybe buy some bonds, maybe buy some gold, build some cash. The best hedge is not going short, right? The best hedge is just owning less of the asset you want to hedge. And for most of you, that's just building some cash. So maybe trimming some of your winners, okay? Trimming some NASDAQ 100. We've had an incredible run, right? And although this does look like a minor blip, it happens. It happens, okay? So trim some stocks if you'd like, if you're getting a bit worried about growth, etc. Trim some of the names in your portfolio that you really want to see. Maybe buy some bonds, maybe buy some gold, TLT, AGG, ticker GLD. Those are some great hedges. Otherwise, there's nothing wrong with just holding cash and collecting a 4 to 5% yield while the market Trump goes ahead and does its thing. Now, the RTY, a very similar situation to what we're seeing with the NASDAQ 100 and S&P 500, but we're actually below the Trump gap up. This was the Trump gap up we made in the RTY. We're well below that. And right now, we are slightly in positive gamma, but it looks like we are going to move lower. 2000 to 2017 is our target level, and this would coincide with some very, very key levels here in the Russell 2000, as you can see right here, guys. So this is a very, very key level. If we go ahead and continue the breakdown, 2000 needs to hold. Otherwise, things not looking that great. But this 2000 level, there is a ton of volume right here. So look for the Russell 2000 based on valuations and based on what we're seeing with growth. This is probably where I would start accumulating the lower end range of the scammer flip zone. So look, I think the Russell 2000 looks good there, but don't buy the Russell 2000, guys. Just look at the SP 600. I'm not sure what the ETF ticker is, but it's better to buy something like this over the Russell 2000. These are profitable small caps over just like higher beta, unprofitable names. It's also just a little bit more concentrated, which is a good thing. Looking at the dollar, it looks like exactly what I said last week would play out. We're going to see a bit of a relief rally and then a move lower. If we go ahead, break these lows, we're going to target 105. And then from there, we can target 103, but one step at a time. You want to see the dollar right here. You see this candle? If we go ahead and break these lows right here, have a close below these levels, that would be very constructive for us to go ahead and hit the 105 area meaningfully. The 30-year yield continues its move lower. I think we should find some form of support here at the 4.3 range, and the 10-year yield, we should probably find support right here at the 4.1. If we don't, I think we see a very, very quick move to some of these lows that we made here at 3.8%, 3.7%. So, the 10-year yield at a very, very critical juncture. For those of you that don't know, in early January, I actually called the top in yield and the dollar. Here's the Twitter post I did. We are probably going to move lower. I think we're going to find some support right here like we did at this area and like we did right here. Remember, resistance turns into support, guys, but I do think we are going to move lower, especially if the economic data continues to deteriorate in the way it has. For all intents and purposes, guys, what you want to do right now is trim. Maybe position your portfolio into some defensive assets, bonds, gold, TLT, AGG, and just build some cash. However, if opportunities do present themselves, definitely go ahead and take that. For example, let's have a look at Nvidia. You go ahead, measure Nvidia peak trough, right down 26%. This is an attractive place, especially if you think Nvidia next year is going to do $6 in earnings per share. You apply a 20 multiple to that, it's $120 per share. The stock is trading at $114 per share. Now, momentum is definitely towards the downside. We do know that the hyperscaler CapEx numbers are not going to materially be affected this year. That money is going to go to Nvidia. Now, there is some concern with regards to export curbs and the article I read you a couple of minutes ago. However, I don't think that's going to materially affect earnings in the here and now. And this is a great space to accumulate Nvidia. Another name I do like, EVBTY, saw immense relative relative strength, and we are starting to break above some of these levels right here. Once we get that moving, we should see $100. And this is not correlated to the S&P 500. This is a European stock. It was up 2.56% today. So those are the two names that I really do like. Otherwise, guys, start strategically looking at names you like. Have your watch list ready, build some cash, and all you have to do now is sit through the volatility. More downside is likely to come. However, don't forget, we are in a bull market and we are in a very, very clear uptrend. This type of volatility, it happens. It's something we have to deal with to get outsized returns in stocks and equity markets. Diving into sentiment, this is Goldman Sachs Equity Sentiment Indicator. It just measures positioning of institutional, foreign, and retail investors versus their positioning last year. In other words, this number is telling us that investor positioning is slightly lighter than what it was 12 months ago, owing to the fact investors have become a little bit more concerned with regards to the equity picture, the macro picture, and the fundamental picture. Now, why have investors become increasingly more cautious with regards to sentiment? And I think part of the reason is earnings. Looking at Q1 consensus EPS estimates, we have seen very steady revisions to the downside, particularly in some of the big sectors. Look at consumer discretionary, down 8.8%. Look at financials, we've seen negative 3.8% revisions. Look at stuff like tech, nearly 1% in revisions. For total S&P 500 revisions of negative 3.5% respectively. And that is always going to weigh on sentiment. I also think looking at seasonality in a presidential election year, the first quarter tends to be pretty weak in aggregate. And I think we are seeing some of that sentiment churn occur under the hood. But I think the big picture has to actually do with the macro. What we saw on Friday was Atlanta Fed's GDP now went from about the 2.3% range to negative 1.5%. And this is because the trade deficit blew out. You see, import numbers came in huge. This is probably from businesses front-running tariffs. That is now showing up in the data. And when you have a huge import number, it actually subtracts from GDP. Major players on the street actually have GDP closer to 1% right here. And when we actually get the inventory data, some of this number is going to come back. I think definitely above the zero line, but there's no denying it right now. This is definitely a slowdown. And it's becoming clear that higher rates are having that lagged flow-on effect into the economy. I think what we're also seeing is that tariffs are weighing on the economy as a whole. Now, we did get personal income data that did come in better than expected. As you can see, this is what the market expected. This is what we printed on Friday. So that was a positive. However, the savings rate did tick up in a very big way. So people do have the means to spend because they made more money, saving more. But this is also a bit of an ominous signal. Generally speaking, people tend to save more when things are looking a little bit foggy on the horizon. So that is a little bit of concern there. What we also saw with regards to the GDP data is that the expectations of a June rate cut have come back to nearly 75%. That's actually tangible. And just a couple of weeks ago, it was as low as 34%. Now, guys, I follow a weight of evidence approach, and the weight of evidence has shifted. My overall expectation for stocks was that, earnings and fundamentals were looking really, really good. Margins were expanding and the macro was firing on all cylinders. That is starting to change. The macro is starting to turn because of this administration, and we have seen downward revisions in earnings. And we do need to identify and we do need to follow the evidence. And the evidence is pointing to an increasing chance of a potential slowdown. We have to see how that all pans out. We are still in a bull market. And for the most part, looking at the data over the last 6 months as well as earnings. Now, Q4 earnings is extremely good. So there's a lot of conflicting signals, but in the year and now, I am cautious for a slowdown, and I will update you guys regularly on what that means for the economy, stocks, and the financial market. So you don't miss a beat. Go ahead and subscribe because things are changing rapidly. Many people think I'm a bull because I've been bullish throughout 2022, 23, 24, and for the most part 2025, but I'm not actually a bull, guys. I am actually just someone who wants to make money. And we can do that in bear markets and in bull markets. And we do need to position our portfolios accordingly based on the evidence we have at hand. For all intents and purposes, guys, things are changing in real time, and you will get my unfiltered thoughts every single day here on this channel. Now, let's actually talk about what can move the market this week. A big one is earnings now tomorrow before the open. Target, Best Buy, C, AutoZone. They are the big names reporting. And then after the close, the biggest name here is going to be CrowdStrike. Everybody is going to be looking at this for cybersecurity, what it means for AI. Box is also reporting, but we have some very big names reporting here on Tuesday. That's definitely going to move the market. In terms of data, we don't really have much of anything, but Wednesday we do have the ISM services PMI, and I believe the ADP figures as well. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.